Hey guys, welcome back to the channel. In today's video, we're going to be breaking down some investing, giving you kind of some tips and tricks through here. Now, I am not a financial advisor. I do not do stocks and bonds, so make sure to do your own research, guys. But again, I'm going to go over some general tips on investing, where to get started, how to get started, and just some general guidance. So we know in a couple of our last videos, we went over the 50-30-20 rule, which that final 20% is what is set aside for debt repayment, which is set aside for investing. At this point of our strategy, you should have all of the debt paid off, which means we're going to be looking at the 15% or the 20% of the income of the 50-30-20 rule to go ahead and invest. Before we get into the video, guys, go ahead and click on the subscribe, turn on notifications, stay up to date on all of the videos. So let's go ahead and get into it. Now, some of the general things, guys: start investing as early as possible. Returns are compounding if you have time, 5 years, 10 years, 15 years, 20 years until retirement, or if you're saving for something, a much larger purchase. It is really the time to invest. There is never a bad time to invest unless you're sitting on a ton of debt. Now, the first strategy, guys, number one, make sure if you have an employer-sponsored 401k plan, something of that nature, or if your company that you work for offers matching, always take full advantage of it. If they're willing to match 4% of your salary, make sure you put 4% of your salary up front into a plan like that. The rest of it, meaning if you're putting 4%, the other essentially 16% we can put elsewhere, which again is some of what we're going to be going over today. So again, deciding how much to invest, you really have to break down your budget, which was the very first thing we did, guys. You can check back at some of the older videos, look at some of the budgeting strategies that we had, some of the tips and tricks that we had in there, and making sure that you have a budget, knowing exactly how much you want to invest. Once we have our emergency fund built up, our first 1,000, debt is consolidated. Now we have 3 to 6 months of our emergency fund built. Now it is the investing portion, guys. This is really the big one where you see compounding returns over time, which can lead to an incredible wealth generation. So again, really thinking, breaking down your budget, seeing where you are going to have the funds to invest and where you need to invest them. My personal preference, guys, I use M1 Finance. I have a link down below, an affiliate link down below. Absolutely phenomenal on the investment side. Has a ton of investments with no fees to you, which are very, very cool to see. Now, some of the investment options, guys, you have stocks. Now, again, this is a very beginning guide to investing. If you're investing in stocks, you are owning stock in a single company. So when you look at companies like Google, when you look at Apple, when you look at Amazon, if you're buying into a single stock, there is a little bit of risk, which is the reason, again, do your research, seek out a financial advisor if that's what you want to do, or you can just go ahead and take a risk with it with companies that you know. And I really say that with a grain of salt, because again, you really need to do your own research. But stocks, again, are looking at single companies. So if you're buying shares of Apple, you are going to be, your performance is going to be based on Apple. You are just buying one individual stock. Price can go up, price can go down. It can have dividends, things of that nature, but you are tied to one single company, which is a little bit scary for a lot of people, especially if you are newer into investing, because we like to minimize the risk. So if you have a major lawsuit with a Fortune 500 company, it could really tank the stock price, meaning that everything you put, again, using theory of putting all your eggs in one basket, could be very detrimental to your stock portfolio. Second one we look at is bonds. Now, these are government bonds. You can also get municipal bonds. There's a couple different aspects. A lot of times with bonds, they are a much lower return over a longer time frame. The big thing with those is most of them, you know exactly how much you're going to be earning, how much the bond pays. So it is a very low risk investment compared to stocks. Now, bonds, of course, most of them are government backed. When you look at savings bonds, when you look at I bonds, when you look at things of that nature, they are government backed, which agrees to pay you a certain amount of money over a certain amount of years. But when you look at traditionally, stocks usually outperform bonds, even though there is the risk factor in there. But again, we're looking at long term. Long term, I mean 5 to 10 years of having your money invested. Then we get into mutual funds. Now, mutual funds are where I put a majority of my funds because you can actually kind of, instead of picking individual stocks or picking bonds, you can pick mutual funds that have a combination of all of them. For instance, I put money into the S&P 500. The S&P 500 is a mutual fund that I put a considerable amount of my investment in because the S&P spreads your investment among the 500 largest companies within the United States. So it does make a really big difference because now you're just not, again, in our example, investing in your Amazons, your Apple, your Google, but you're investing in the top 500 companies in the United States, which also crosses other sectors, which means it's not just technology. It's not just, it's not, there's multiple sectors. And again, I'm not trying to get too complex. The basic how to invest, there are a lot of different sectors. You have an energy sector, you have a finance, you have a lot of different sectors that really do make up, the stocks that a company has. And this reaches or goes across all of those sectors to pick out the 500 largest companies. So you do have exposure to multiple sectors and you have exposure to a lot of different funds. Now, exchange trade funds, like mutual funds, it holds investments and it bundles them together. A lot of the ETFs are built by companies, so they'll actually choose what they want to put into a fund. And then kind of go from there. People buy into the fund. That is what essentially you're buying parts of what they put in there within the fund itself. Now, picking an investment strategy, this is really the big part when it comes to the personal preference, and it goes to building out exactly what you're looking to do. Again, 5 to 10 years of investment is kind of a general rule of thumb for investing. A lot of people, even if you're starting earlier, guys, if you're putting away money for a house, if the house again is 5-10 years out in the distance, it's not a bad plan to have something low risk. That way you do have access to the money if you need it. But a lot of it is going to be for a longer term investment. And also you're going to see the compounding aspect where if you're putting $200, let's say, into the S&P 500 every single month, over the course of 5 years, over the course of 10 years, with the returns that you get. So not only the growth of the stocks within the portfolio, but also the dividends that you get out of there. A couple different things. Again, when you look at what you're investing in over the long term, it's yielded about a 10% return for the S&P 500, which again, compounded by 10 years, 15 years, 20 years, that is a considerable amount if you're making regular investments in there. So guys, that'll do it for today's video. Again, just wanted to give you a real general overview of investing. Again, the earlier that you get into investing, the better, guys. It can allow your investment to grow. It can also offer you returns. But the more time you have, the better set you are going to be when you do need that money in the future. So let me know in the comments what you guys think. And as always, thank you guys for watching.